And we should be live. Welcome, everyone. I am Thoughtful Money founder and your host, Adam Taggart, welcoming you here to another, what used to be Monday mornings, Monday Morning Macro with Stephanie Pomboy, which is now Wednesday Morning Macro with Stephanie Pomboy. Stephanie, nice to see you here on Hump Day.
Yeah, I was just going to say happy Hump Day. I kind of like this better. You get a little bit more momentum at this point of the week.
Right. So anyways, lots to dig into, lots to discuss. Folks, hopefully y'all got the memo and are joining us now, and we'll be on our regular bi-weekly schedule from here, just on Wednesdays. All right. So before these things go live, Stephanie and I, we exchange some texts and try to figure out what the theme of the week is going to be. For this one, we sort of zeroed in on, are the beatings over? Is the worst of this correction behind us? We've had a rough month in the markets. We have seen some initial bounce here. Of course, right after I created the thumbnail and title for this video, Stephanie, is there a rally on in the near term? Markets are down today. Of course, that's just Murphy's Law. Who knows where they'll close today? Maybe they'll close green. We'll see. But we got lots to talk about that. Obviously, I'd love to get your thoughts on the recent FOMC release and questions by Jerome Powell. Last time we talked a week and a half ago, you were quite concerned about recession risk. Just curious if the data we're getting in since then is corroborative of that or not. Number of other questions. We'll obviously get to some audience Q&A if we can. And we have a little bit of a shortened time today. We got to get you out of here 15 minutes before the end of the hour. So lots to cram into a short amount of time. Let's start with the theme of this week, which is, are we through the woods here? I mean, at least in the near term.
Yeah, I mean, it's funny. You said the markets were up, and I guess it depends on what market you're looking at, because we're down. S&P is down, Dow is up, NASDAQ's down. So it's kind of a mixed bag now. But in general, I think we had this 10% correction, then we've had a bounce off the bottom, and recovered about half of that at this point, a little less. And so, I guess the inclination is to say, well, that was just, we needed the correction and the opportunity to buy at better prices, as they would say. But I don't think anything has changed fundamentally. If anything, there seems to be even more uncertainty around policy coming out of the administration. That's I think one of the major issues for the market. And it was reinforced this morning. The Richmond Fed, in conjunction with Duke University, does a quarterly survey of CFOs, and they came out and expressed a little more pessimism in the first quarter. And it was entirely around uncertainty relating to policy. And the tariffs were obviously kind of front and center in terms of their concerns. I think tax policy probably secondary. They were obviously quite optimistic about the regulatory backdrop, but the tariff thing is kind of this looming unknown, both in terms of timing and expansiveness. So it's hard for them to make decisions, understandably, in an environment where they're not really sure whether their supply chains are going to be disrupted by these tariffs or not. So that's kind of stifling a lot of what would be CapEx and hiring. And interestingly, and I think we talked about this when we chatted the last time, Adam, that at that point, the University of Michigan sentiment survey had come out and reflected incredible pessimism on the part of consumers about the labor outlook. And I remarked, I believe it was in our conversation, that they tend to lead the actual data because they have a much better real-time sense as to what's going on out there. So it was kind of reinforced with the CFO survey, where they're kind of sitting on their hands a little bit in terms of both CapEx and hiring. So in that regard, it's hard to see where there's any basis for this sudden reversal in the stock prices, other than, you had a correction. And for those who were still bullish, it was an opportunity to, buy it at, like I said, better levels. But nothing fundamentally has changed near as I can tell. And we'll get an update on the Atlanta Fed's forecast for the first quarter sometime in the next, probably while we're having this conversation. but they're at roughly -2% for the first quarter, and their consumer spending component, importantly, is almost zero. If it actually prints at that level, it'll be the weakest first quarter since COVID and the Great Recession before that. So that's clearly a recession signal right there. So anyway, let's just say I'm not convinced that the worst is behind us for the markets. And another thing that I've been really focused on for years now, as you know, is corporate credit. And the situation there just continues to devolve. And we're finally starting to see that reflected in asset prices with junk yields and even investment grade yields moving higher and spreads widening dramatically, because you've had this sort of rally in treasuries and nominal rates in both investment grade and high yield have moved higher in the face of it. So you've had a pretty significant widening of spreads, which is new and different. We hadn't seen that prior. So I think there are signs that this reversal in the markets, in the stock market, is really just kind of unbridled enthusiasm with very little basis in reality.
All right. So, there are a number of technicians that I've been talking to, reading of late, who were saying, as stocks got more and more beat up, we're saying, look, they're short term, getting very oversold. They're below the Bollinger Bands, all that type of stuff, right?
Yeah.
So there's been a lot of talk about, hey, there may be a snapback here in the near term, and a number of them are still saying so, especially as we go into the end of the year, end of the quarter. Sorry, I mean, and people start rebalancing and trying to buy the companies that did well, or companies they think are now too cheap in the short term again. So I'm guessing in the next week or two, you're probably like, look, it's anybody's game. But obviously you're mentioning a number of things that will continue to weigh on the market here. And in the near term, we've got April 2nd, right? Liberation Day, as the president's calling it. Right?
Yeah.
And while you were talking, I was trying to pull up to see what exactly is going to happen on Liberation Day, and I got to say, I didn't get the clarity I was looking for.
Yeah.
It's reciprocal tariffs. It's unclear to me exactly how many countries that's going to go on, but I know that Trump had paused the tariffs on Mexico and I think Canada as well, so those should go on, and then there's going to be, I think not just those companies. There's going to be other reciprocal tariffs in other countries, and of course, as countries then respond to our tariffs, we'll then reciprocate to those. So there's a lot of uncertainty as to what's the snowball effect of this might be. So obviously that's not really good for markets. You talked about widening credit spreads there, which is something you and I have been talking about for a long time.
Yeah.
Saying, hey, it's an important warning signal that we haven't seen and that we're going to watch closely. It sounds like you're saying, hey, you're now seeing some real movement here. I was talking about this the other day with Lance Roberts, and he said, yeah, they've been moving, but you got to widen out the lens, because if you do, that movement's still pretty small compared to where they've been historically. But I don't want to diminish it. I mean, how material do you think the movement we're seeing now? Because it's almost kind of like seeing somebody you had left for dead, and at least the legs twitching now, and you're like, oh, wait a minute, maybe they're actually maybe there's some life there.
Yeah. Well, as I like to say, the journey of 1,000 miles begins with a single step. Obviously not my expression, but I repurpose it when it comes to these credit spread things, because, you see a lot of people who do that more expansive history, and you can barely identify that there's been any widening of spreads if you put it in the context of, let's say, the last dozen years or so. So absolutely true that it's been modest, but it has been more significant than anything we've seen over the last couple years in the face of this largest wave of corporate bankruptcy filings since the global financial crisis. So it's interesting that all of that unfolded last year, and spreads, we went through periods where spreads would back up a little bit, but nothing on the magnitude that they are currently. And again, I think you are starting to see that this is becoming a little bit more of a problem that's being acknowledged in the corporate sphere. Moody's came out with a report last week where they have their own sort of early warning system where they identify stress default probabilities, in different sectors. And they, this is interesting to me because those of us who went through the subprime crisis and the financial crisis that followed that well recall that Moody's and the other ratings agencies were way too Pollyannish. They're very restrained in their concerns about the subprime market. I would say even borderline dismissive.
Right.
And now they seem to be seeing a lot of stress forming, and these early warning systems that they have are triggering, 30-40% of companies in different industries, like specifically media, healthcare, are at risk of default. So those are huge numbers, and if Moody's is identifying that kind of level of problem, and of course their hair isn't on fire because they just, this is our early warning system and blah, blah, blah. But to me, it's an indication that there are real stresses out there that are catching the attention even of these ratings agencies that tend to be fairly restrained. So that is also different. But I think the key will come down to earnings. And that's the other moving part that we're starting to finally see, is that earnings estimates are being revised downward, which is generally a real headwind for stocks and for credit, because obviously if you're not going to earn as much, you're going to have an even harder time servicing debt that's rolling at higher rates. And just by way of a reminder, corporate sector has to roll $1 trillion worth of paper between now and year end. And then once they get done with that, there's another 1.2 trillion lined up for 2026. So there's no respite here. And unless interest rates really start to come down dramatically, they're going to face significantly higher debt service in an environment where their earnings are slowing, if not actually declining.
Yeah, so we have, almost everybody I've talked to, like you, Stephanie, has said forward earnings estimates for the S&P are like totally unrealistic.
Yeah.
And so there's this, expectation, at least among the analysts, that that's going to start getting walked back, and that eventually stocks are going to have to reprice for that. And that's not taking into account this corporate maturity debt wall that you're talking about, right? So you kind of have these sort of the worst of both worlds, right? You've got these two potential real headwinds, beginning to increase here for markets. And just to remind folks, the analysts who really look at liquidity closely, folks like Michael Howell, folks like Darius Dale, are quite worried about the weighting that's going to have on asset prices as we really start to experience those refinancings in earnest as we go further into this year. And of course, Stephanie, too, this isn't happening in a vacuum. We have 10 trillion in U.S. government debt. That's
exactly. The competition for capital is going to be fierce out there between the public and private sector, which kind of brings us, if I can, weave it back to the Fed last week, because, I thought the decision to taper the taper was the most important thing that came out of the meeting last week. And of course, Jay Powell spun it as a technical adjustment, as if the expansion of the balance sheet was a technical adjustment to what, how can slowing the runoff not be a policy function? It's clearly a response to something. If everything was so fine, why did you change anything? So it was a completely disingenuous spin on his part of what the committee decided to do. But the reason I dovetail this back to the conversation about credit issuance and the 10 trillion in debt that needs to be refinanced by the public sector is that the last thing we need right now, when we've got 10 trillion in debt that matures, treasury debt that matures, and foreigners, as we learned the day of the press conference with the treasury capital flows, sold another $50 billion in the latest month of our paper, is for the Fed to be selling on top of it. That's just not anything we need. And at least we can control that part of it. We can't force foreigners to buy our paper, or, Trump may eventually try to do that with these tariffs, but the Fed can at least get out of the way. And I think that's kind of what's happening here, is that first they slowed the taper to 25. Now they're taking it to 5, on the way to completely stopping the balance sheet runoff. And then shortly thereafter, re-expanding the balance sheet as they come in to sop up all the excess treasury supply. That's my forecast. It has been for a long time, and I'm sticking with it. So,
All right. So that's where I wanted to go next. So first off, so you think that this is on the way to basically a resumption of some type of QE?
yeah,
Um,
by a
and
different name. They won't call it that
they won't
because
call it that name.
you know
Okay.
that.
And just to make it clear, this isn't necessarily uh, only as a rescue effort. So for a moment, let's assume the economy doesn't fall into a bad recession and the markets don't crash and the Fed has to ride to the rescue with QE. You're saying even if that doesn't happen, you sort of expect them to resume QE under a different name?
Yeah, well, I think that they'll probably, if there is no need to rescue the economy or if some segments of the financial system, then they'll probably implement something like an Operation Twist. They're going to figure out a way where they can pin down the long end of the yield curve, which is really the ultimate goal here.
Hmm.
And I think they want to do this, or certainly Secretary Bessent wants to do this without relying on issuing T-bills to finance our deficits. So,
Hmm.
the only way you can do that is if you're going to have more supply at the long end, you need to have more demand at the long end to
Yeah.
meet that too. So, I think you would probably come up with a little bit of a balance sheet twist situation with the Fed, under whatever guise it is, coming in and helping to manage the long end of the yield curve, like Japan's yield curve
Yield curve
control
control. Yeah.
situation, such that they can avoid using the terminology of quantitative easing, which will immediately get everyone all hot and bothered about what's really going on out there in terms of the monetary integrity, as if we had any feint of monetary integrity anymore. But
Yeah. I'm just curious, and we're getting a little wonky here, but so Powell did dramatically reduce, or the Fed did dramatically reduce the quantitative tightening going forward with Treasury bills. They're leaving the mortgage-backed securities alone.
yeah.
And Powell has basically said more or less, we want to get out of that business. Do you think the Fed will ever buy mortgage-backed securities again, or do you think it's genuine that it really just wants to have a clean balance sheet going forward?
Gosh, well, I wouldn't rule out the Fed buying any securities of
Yeah.
any nature at all anymore. But and I don't believe anything they say, and nor should anybody at this point. But I mean, I think clearly they would prefer not to be buying mortgage-backed securities, and the housing market's an issue. Although I would say right now, given all the things, the threats on the horizon, what happens in the corporate market is probably more has more immediacy to it because of the reverberation through the financial sector. Whereas
Mhm.
I don't know that the housing market poses the threat that it did. It certainly doesn't pose the same threat that it did back then. And I
Right.
think the corporate market, because of this mushrooming in private credit and the opacity around that, but the interconnectedness of that with financial institutions, could create real problems that the Fed really doesn't have much visibility into right now, and it makes it complicated. And so I would think, that's the more likely area where they might target, create some kind of long-term facility to extend credit to various segments of the corporate market rather than getting back into the housing market
Okay.
necessarily.
I'm going to ask you again to sort of prognosticate here a little bit. I know you've got imperfect information. But so I was listening to Treasury Secretary Bessent, who I got to say, I didn't know much about him before, but he certainly seems like a smart guy.
Yeah.
He's doing a lot of things that if I had his role, I would be thinking about doing. So far, I think he's a pretty good mind in that chair. So he's deregulation is really a big priority of the government. And he was talking about private credit and speaking quite favorably of it, because they want to deregulate the banks, right? They feel like the banks have been too hamstrung. and that they haven't been lending enough, right? And so he feels like, well, private credit has sort of been taking up the slack because it is it's not regulated. It is, I mean, we're saying opaque, but it's a little bit more the Wild West. They can do what they want, right? And so I can understand that side of the argument a little bit. Of course, the skeptic in me, says, oh my God, like there's no visibility. Like how many terrible loans, subprime type loans are being made in private credit that we have no idea, right? So like, what's the Warren Buffett, when the tide goes out, who's been swimming naked risk here in private credit?
Yeah. Well, I would say first, I have no problem with the idea that they can have an unregulated lending system and you can have private credit extending credit to enterprises that banks won't lend to because they're harnessed by all this burdensome regulation. I appreciate that argument and I have no problem with it. But then don't run in and bail out these people the second that they get into trouble. Like there has to be downside and there has to be pain involved in that so that these independent lenders realize that they don't have a safety net under them. Like if you're going to extend credit, if you're going to extend credit to some business that has no viable business model and hope that if you get into trouble, the feds will bail you out, like that's just not an environment, that I think there's some of that moral hazard behind what's going on here. But more importantly, rather than speculating about, the thought process behind some of these private credit guys, is that they are connected to the banking system because a lot of the private credit funds get funding from the, banks through various programs. But also they're connected to the pension system, which is, the bee in my bonnet is that the people who have been just shoveling money into both private equity and the private credit that funds a lot of those private equity ventures are the pension funds who've been desperate to try and find higher yielding alternative assets. And so to me, I totally appreciate Scott Bessent's argument that we should be able to have a less regulated financial system. But when they get into trouble, which they're going to do right now, then we have to let the chips fall where they may and face the consequences and let the markets work out the excesses. Just like we let the markets extend the credit, they have to take the lumps when everything goes bad. And that's not how it works out. And I have to believe that when it comes home to roost on public pensions, there's no way they're not going to bail them out. I mean, how can they bail out Wall Street after the financial crisis and then say, hey, all you, policemen and firemen and teachers and whatever, sorry, you're not going to get your pension because it got blown up in some of these private equity vehicles. So.
Yeah. So there's a video I want to do with you at some point in time where we bring in Ted Seidel, who
I would love to do that.
Yeah. Because talking to him is always totally hair raising when he just talks about how poorly managed most of the pension funds are. Right. And to your point, they kind of have a massive put on them, right? Where, will CalPERS ever be, allowed to go bankrupt if it's, poor investments blow up on it? No. Right. So, we, sadly, I guess, for those of us that are paying in but don't benefit from it, we already kind of know that, like, oh man, if this thing ever goes south, my taxes are going up to bail these pension funds out. Yeah. So, all right. So it does seem like, there is a risk there. I think of the scene in Blazing Saddle where the guy puts the gun to his own head and says, don't move or he gets it. Where private equity might do that a little bit, where they're like, look, we made some bad loans, you better bail us out, or else the domino effect's going to take down the pensions and then you're going to have to bail them out. It'd be interesting to see where the authorities decide to put the bulwark, whether they to your point, let private credit take its licks, but they back up some of the collateral damage, or they say, look, we don't want this to turn into a conflagration. Let's spend less, even though we hold our nose and spend less and bail out the private lenders to save everybody else. I don't know, but the jaded guy in me feels like it's probably going to probably be more like that. I mean, this is a little different, but we saw sort of similar with Silicon Valley Bank. right? That was not a
Right.
systemically important bank. Those deposit holders should have taken losses, but for the sake of confidence in the system,
Right.
they bailed out all the irresponsible tech bros in that bank.
Yeah, absolutely. No, I share your cynicism about that. And I think it's well deserved because we've watched this happen so many times at this point that it's just hard to believe they won't revert to standard operating procedure. And again, because I think there's this level of opacity around the private credit, the fear of the unknown is so great that they'll just want to throw a life raft and create some big enough response that it allays any concerns because they can't really quantify how big the problem is. So I feel like the impulse to do something, what did they say from Animal House? This situation requires something, big and stupid be
Stupid.
done on
Yeah.
somebody's part, and we're just the guys to do it. I mean, I feel like that we'll see that one replayed a little bit, but anyway.
All right. Well, look, we're talking about a lot of
Old
potential
movies,
negative. Well,
right?
yeah. Well,
Well,
hopefully our
yeah,
crowd here gets most of these.
yeah,
But we're talking about a lot of big risks. I want to talk about one more risk, and then I want to actually talk about some things that could be surprises to the upside. You probably heard the latest, buy now, pay later news, where I can't even remember, it was a Walmart or someone just struck a big deal, but more, egregiously, DoorDash, I think just did some sort of agreement. So you can basically buy your takeout fast food, on 4 easy installments at a 37%, APR or
yeah,
whatever, right? I mean, I feel like I'm on record saying this is the most predictable headline of the future, which is, oh my gosh, who could have ever seen all these buy now, pay later losses that we're taking, right? I mean, it is. I mean, obviously, this is a sign of well, I shouldn't put words in your mouth. To me, this seems like an obvious sign, both of sort of reckless lending standards, not necessarily in the banking system, but on the lending side. And then secondly, this to me seems like a strong sign too of a struggling consumer.
yeah,
Nobody with 2 brain cells should be financing, their dinner, right?
yeah,
Unless you literally don't have the option.
right. I mean, you're either very financially ignorant,
Mhm. Which
which it's hard
sadly,
to
I
believe
mean,
anyone could, be that ignorant because you do get the bill at some point. But yeah, it does seem like a sign of stress. And like you said, on the other hand, folks that are very willing and able to take advantage of that stress by coming up with newfangled ways to exploit it and lend to people that really shouldn't be borrowing. Certainly not for those kind of expenditures. So yeah, it's scary, but we've seen this bifurcation of the consumer for so long, and people pay a lot of lip service to it because so far, the issues, the stresses haven't been big enough to really topple over anyone super important. But we have seen, a huge increase in credit card delinquencies and serious auto loan delinquencies. So all of that is clearly happening, but it hasn't slowed down the pace of lending or borrowing, near as I can tell.
so I just released a video with Wolf Richter, and Wolf basically said he doesn't have a recession in his base case for the year.
Hmm.
And I think philosophically, he's like, yeah, we totally deserve one. Like the system we've got a lot of unsustainable elements of it, sins of the past that are going to catch up with us. But as he's a big charter and he looks at the data and he's just like, I just don't see anything that is flashing bright to me that like we're in danger of sinking into recession immediately. And one of the things he talked about was retail sales. And I know you're looking at the retail sales data and saying, look, they're not great, right? But they're not falling off a cliff yet either. And basically what Wolf is saying is look, I agree, it's a K-shaped economy and the bottom part of the K is probably doing worse as time goes on. But he's like, as long as those short end of the K is spending enough to keep overall spending, kind of in the same ballpark, the system's going to kind of hold together. And he's like it or not, it's, spending doesn't, the GDP doesn't really care where it comes from, as long as
Right.
it's being spent, right? So I'm just curious, A, what do you think about that? And B, are you seeing, I mean, I see headlines here and there that say we're seeing signs of cracks even in the affluent investor, the top end of the K, but clearly not enough yet to, materially change the trajectory or the phase state of retail spending yet, at least.
Yeah. Well, I go back to a couple things. Number one, I mentioned at the top, the Atlanta Fed's estimate for the first quarter has consumer spending at zero, and that's a recessionary reading. So that I think kind of controverts or whatever is contradictory to this idea that consumer spending in the aggregate is holding up well. And then, of course, if you strip out the things that people have to spend money on, like housing and healthcare, the spending is, clearly in recession territory. And then I don't need to recite what we saw with consumer confidence yesterday in University of Michigan and all these surveys that reinforce the idea that consumers really aren't feeling that great. But going back to the idea that, the top end of the K is really supporting things, and it's true, GDP doesn't care who's spending the money as long as they're doing it. Obviously, all of that hinges on what happens with the stock market. And if the headwinds that we talked about at the top, the downward earnings revisions and the corporate refi wave and the struggle to service debt at higher rates around that, begin to weigh on stock prices, and the correction that we saw unfolding earlier resumes, then you've got a real problem, because that top end of the K, whether directly or indirectly, is spending their wealth. They're spending their psychological market gains. So I think that would be a huge drag on consumer spending. This is why I keep coming back to the idea that the stock market is the tail wagging the economic dog anymore. And so, I don't have a strong argument about the high-end consumer presently, but I will tell you that if the stock market craps out, you will definitely see that reflected in the consumer spending numbers.
Okay, and just to be totally clear or factual on Wolf's position, he does not have a recession as his default case this year, unless there's a stock market correction. So he thinks just like you. He says, look, the thing I worry about is valuations, right? And he says, I don't know when it's going to happen. Could happen tomorrow. Could happen 2 years from now. But if this market corrects the way that it should, just to mean revert valuation wise, that's going to create a strong negative wealth effect. That's going to send the economy into recession. Sounds like you're saying the exact same thing.
I mean, if this stock market mean reverts, it's going to be more than a recession.
Which is crazy, right? I mean, which is, one of the things we talked about or people are talking about now is, wow, the stock market, at least sentiment wise, is either in complete euphoria or complete despair, right? And, as we saw the market marching down on its way to being down 10%, even at 5%, 6%, the sentiment was like extreme fear, like the world is melting down, right? And part of that, I think, is because we've sort of trained investors for the easy ride with passive investing, right? So anything that's just not a steady rise up, feels totally unnatural. But I also think more too, we now have much more speculation in the market and many more speculative tools, single stock leveraged ETFs, 0-day expiration options, things like that, such that when the market does, go down a little bit, sure, the vast majority of investors are down 5%, 10%, whatever. They're feeling the natural amount of pain for that. But now you've got this tail that is so hyper leveraged that they are bleeding from the eyes, right? So their pain is actually bringing the averages down a lot more versus a system that doesn't have those extreme, that extreme participation in leveraged amounts. You're sort of nodding here,
Yeah, no. And I mean, it is interesting to see how they just shovel more and more of these products at retail investors. I know that there have been a number of funds now coming out that give them exposure to private credit, so you can get some of this too, so it's a little scary. But these are the kind of things you generally see at the top. Of course, we've been seeing these kind of, ETF offerings for quite a while. So it's hard to know, I figured once they started doing the private credit funds that you were probably near the end, but, I probably would have said that a year ago. And
Yeah. Well,
So,
and we can look back and say, look, there were lots of signs of worry in '06, in '07, but it took a long time for the elephant to start keeling over, even though we all thought it was in trouble beforehand. All right, so look, we've talked about a lot of risks. Let me just talk about a few things here that may surprise to the upside. So I guess first, and this is all, I'm just asking you to speculate here, so look into your crystal ball, as murky as it may be. We're having serious conversations right now between the U.S. and Russia and Ukraine, so we may get a peace deal out of this. What sort of impact, if any, do you think that may have on markets from here? Is that already mostly priced in at this point, do you believe, or could that add a nice upward gust to the markets if the deal indeed gets struck? And
I mean, we keep going back and forth. It feels like we've kind of thought we had a deal, and then it fizzles, and then we go back. So it's hard to know what's priced, but I continue to be very surprised by oil, positively. In that, as soon as Trump was elected, and he campaigned on the idea that he would solve these problems both in the Ukraine and the Middle East. Or let me correct that. I always say the Ukraine. That's not right. Apparently, it's Ukraine.
It's Ukraine. Yep.
Yeah. So, and so when he was elected, you did kind of have this idea that you would have expected oil prices to come down, not only because of drill baby drill, but because of the idea that we would be nearer to peace deals in both of those regions. And yet oil, I mean, as far as I can remember, has been around $68, $69 a barrel. I mean, it's pretty much been churning around that area. I mean, we did dip down a little bit below it and a little bit above it, but basically that's where we've been. And peace deal, no peace deal, ceasefire, in the Middle East, no ceasefire. That's where oil seems to be. We've got this backdrop of incredibly weak growth globally, and yet oil just won't go down. So I guess that's kind of my question is, if we get these deals signed, sealed, and delivered, is that when we see oil go down, or are there forces that are just so strong underneath it that this is going to be the price? I mean, it does feel like they're targeting a price around $70 a barrel, and that's OPEC or whoever is going to try and sustain that that level, which doesn't really. That's just one sort of facet of this question you asked about peace. But I think as relates to risk assets, I don't know that it would materially change the backdrop. I think oil would be the main window into, the main thing that I would expect to react. But I don't really see it being. I see if we got a peace deal tomorrow, maybe we get a brief rally in the markets on that. But I don't know if it would even sustain through the course of the day. I don't view it as a big enough deal.
Okay. All right. And markets, I mean, they generally around the wars and whatnot, I mean, have been surprisingly, not very impacted by that. To your point, you get maybe like a little blip, and then it's typically gone by the end of the day or the week.
Yeah, I mean, I still think earnings will be a much more important factor for the markets than.
And I've asked similar questions to Lance, who I have talked with every week, and he feels exactly the same.
Okay.
I'm just going to ask this question when a different way, real quick, just in case it changes your answer at all, which it probably won't. But let's say the deal is not just a peace deal, like they've stopped. It's not just a ceasefire. It's okay. Ukraine accepts our mineral rights offer in there, and Russia, as it sounds like, is being part of the discussions. We normalize trade relations with them, and you actually start having some economic partnering, or at least trade between the U.S. and Russia, or the Russian bloc, going forward. Would that change your answer at all?
I think it might change my answer a little bit as relates to the dollar, which is interesting. Like, I would think that might be more positive for the dollar. I think that anything that moves us away from this era of the weaponization of the dollar, by trying to normalize relations with Russia and in some way kind of acknowledging that what was done probably was a step too far, in terms
Yep.
of seizing their assets, might be bullish for the dollar in the near term. As to whether it changes the long-term dynamics, I think that's a much larger question, and I'm highly doubtful that it would really materially change the impulse of foreign central banks to seek alternatives to the dollar, just because our fiscal situation isn't in any way improved by a peace deal in Russia. We still have, that's the elephant in the room, really, for us. And the weaponization of the dollar was just kind of maybe the straw that broke the camel's back. But the real problem has always been our runaway fiscal situation and our ability to print money and abuse our exorbitant privilege of the dollar reserve standing to finance it. So anyway.
Okay. All right. So again, on a potential positive game changer, this isn't something that's going to like impact the markets immediately, but over time it may increase our slowing economic growth, and eventually have market implications as well. And what I'm referring to here is the drumbeat of large companies and countries that are committing to invest more in the US. So if you can bear with me just for 1 second, I'm just going to read some of the relatively recently announced deals. And again, this is all announced. The money's not here yet. But United Arab Emirates has committed 1.4 trillion, Saudi Arabia 600 billion, Apple 500 billion, Nvidia 100 billion, SoftBank, OpenAI, and Oracle as part of the Stargate Alliance 100 billion. Taiwan Semiconductor, 100 billion, Johnson & Johnson, 55 billion, Eli Lilly, 27 billion. And then, a smattering of other companies, 20 billion and on down. And that seems to be part of the focus of the administration is, hey, let's bring this capital, into the country. Let's have it fund our reshoring of our manufacturing capacity here. And, it seems like, it's a positive CapEx story. Like, hey, we're investing in this country. We're going to rebuild its ability to make things and be less dependent upon where it used to outsource everything through globalization. What is your gut? Again, I'm asking you to prognosticate here, but how material is this, and how big of an impact do you think it may have long term on the country's prospects?
Well, I mean, I think it's a huge positive long term. And I guess the question is, right now, these are just announcements and they're pledges. We need to see when the reality actually happens. And I would say, if the economy continues to devolve, if growth continues to slow, these plans will be implemented in a very drip, drip, drip kind of fashion. So the numbers add up to quite an impressive tally. If you were to imagine that they were all going to hit the economy, in the next 12 months or something like that. But that seems highly unlikely. And then you also have to think about how much of this money that is being discussed is just money that's being repurposed from, hopefully it was money that they were going to spend developing plant and equipment and supply chains elsewhere that they're now reshoring. But then the question is, are they now having to pay a higher price for that? And what does it mean for margins and this kind of thing? So it's a lot more complicated than just, okay, we're going to pledge all this money and it's great. It's going to be a boon to the economy. It will be over the long term, but there are a lot of moving parts to that in terms of how it gets implemented, when it gets implemented, and then, what the actual cost benefit is for them. Now, hopefully, we get a tax deal that rewards these companies for actually investing here in the United States. And if we had something that was formalized like that, that I think would be a game changer, that said, you're now, if you build it in this country, as Trump has proposed, you'll be taxed at this rate. And if you build it elsewhere, it'll be a different higher tax. So I think that's what we really need to see is the tax bill. And I've been a little bit frustrated and confused about the emphasis on tariffs right out of the gate and putting taxes on the back burner because the taxes are the thing that really are, I would think, going to liberate companies to pursue the CapEx and hiring and really have clarity about, what their business model is going to be going forward.
All right. Well, look, I'd love to dig into that further with you, but I'm looking at the time here. We promised we'd get you out by 15 minutes to the hour. Sorry, folks, for not asking questions. We'll lean more on the live questions next time to make
Yeah,
up for it.
sorry, it's my fault.
No, it's okay.
But
Real quick, Steph, just is there anything that you wanted to express that I didn't think to ask you before you hop off?
no, I think we covered a lot. I mean, I got my hits on the Fed on there, which is always important to me. Never miss an opportunity to take shots at the Fed. But just wanted to make sure no one missed the fact that they were being totally disingenuous, in case any of your audience did. But I'm sure they didn't, because you have a very sharp audience. But anyway, sorry to have it be a little more brief this week, but we'll catch up in two Wednesdays from now.
All right, we'll catch you on 2 Wednesdays. Real quick before we go, folks, if you want more Stephanie, just go to macromavens.com. You can sign up for her service there. You can also follow her on Twitter or X at @Pomboy. And if you want some guidance in thinking through how to manage your portfolio amongst all the macro issues that we've talked about today, fill out the short form at thoughtfulmoney.com, and one of our endorsed financial advisors will be out to talk to you soon. Steph, it's been great as always.
Thanks,
look forward to seeing you in 2 weeks.
Sounds good. Take care.
All right. Thanks for watching, everybody.
Bye.